Joining us now from his offices in Valley Forge, Pennsylvania, Jonathan Lemco, sovereign credit analyst and principal of fixed income at the Vanguard Group. Jonathan, always good to have you on the broadcast. Thank you so much for coming. You just heard Sarah Eisen's report there. I was wondering if we might get your comments on that.
Sure. I think in the short run, at least, although we're seeing a little bit of widening, specifically about 5 basis points CDS spreads relative to LIBOR for Greece, this has more to do, at least today, with an expected large benchmark euro-denominated deal next week. That is, Greece is expected to issue a substantial issue of bonds sometime next week, and that in turn is causing a repricing of Greek bond prices today.
Right.
In general, the market remains wary about Greece, of course, and they want to see some kind of resolution, which isn't going to come for a few weeks.
But Jonathan,
for now, this is
Jonathan, I'm sorry,
more a technical issue.
Right, Jonathan, but I just wanted to mention that you mentioned that the Greek government's going to issue that euro-denominated bond, but it's not a 100% certainty it's going to happen, is it?
It's not, although I think there's a general expectation that Greece is going to have to offer a very good premium to investors before they invest in Greek bonds. That's how you'll get it done under the current very difficult circumstances that Greece is facing. You know, there's a price for anything. So if there's a general perception that Greece won't default, because likely the euro at some point will come through to support them, then it becomes a matter of what kind of a premium is Greece going to offer. And that remains to be seen.
Well, it seems like this is a double-edged sword here, because it seems that issuance would help Greece's fiscal problems, perhaps maybe in the short term, but on the other side, the Greek bonds are going to widen out and they may lose some of their value. Isn't that right?
In the very short run, they may lose value. And in fact, that's what the market's telling us today as we see a widening out of interest rate spreads. But this is a short-term phenomenon. I expect lots of volatility between now and March 15th or so. And the reason I mentioned that particular date is that's the date that the Greek government is supposed to come through with a credible program for the EU in which they say, listen, this is our new fiscal program. This is what we're going to do. And if, in fact, it's something that the market agrees this is reasonable, then expect Greek spreads to tighten dramatically. If, on the other hand, the market thinks, you know, there's not enough there, then I expect a lot of widening. So it could go either way. And in between now and then, every time there's a headline, one way or another, that's moving markets. This is being driven by perception.
And Jonathan, how key is that? How key is the psychology of what's going on over there? As you mentioned, every other day you see a different headline. What's been the effect, positive or negative?
It's working both ways. Every time an EU politician says, you know, we may well have to come through on behalf of Greece, or if a German politician says something like that, that causes some reassurance in the marketplace and spreads tighten. On the other hand, when the Greek president, as he did a few days ago, gets up and says, you know, we can do this by ourselves, at the moment the market doesn't find that credible at all, and then we see a bit of widening. So the volatility is really pretty tremendous, but it's being driven by fear. It's being driven by perception more than any fundamentals at the moment.
Okay, so at this point then, no consensus means we're going to have continued volatility.
A lot of volatility, certainly between now and mid-March. I think the market in general expects that the EU will come through and support Greece as needed. But we need a lot of face-saving measures between now and then to get to that stage, and we're not there yet.
Jonathan, talk to me about the German angle to this. Angela Merkel has been very forceful in saying that Germany would step up and help. What's the effect in Germany and their currency?
She's walking a very fine line. On the one hand, every poll tells us that the German public, in general, is not supportive of bailing out the Greeks. She's got to worry about that. On the other hand, she recognizes that in the medium and long term, it's in Germany's interest, as it is in the broader EU's interest, that Greece remain a part of the EU and that it not default on its obligations. This is tough. What does this mean? This means that for now, Greek spreads may well continue to widen a little bit relative to German bonds, their benchmark.
Jonathan, I'm sorry, but in about 10 seconds, the effect on U.S. bonds, if any?
very small. U.S. bonds are affected by a multitude of different inputs, of which Greece is just one. Gets a lot of headlines, but truthfully, there's a lot more important considerations that go into what affects prices in the United States than just this one.
Jonathan Lemco, sovereign credit analyst and principal of fixed income at the Vanguard Group, joining us from Valley Forge. Jonathan, thanks.